Hey guys, and welcome back to my YouTube channel. In the previous video, I introduced the concept of divergence and rather tried to formulate a foundation to how divergence works and why I'm using it in my current model for trading. And in this video, I just wanted to recap that video and also offer a few examples of divergence happening in the markets, how I use it, and how I tend to take advantage of divergence. This is just a general approach to thinking about divergence, specifically using the RSI as an indicator. I also hope to cover why I am using the RSI as opposed to the MACD, stochastic, and any other indicators that tend to be used in relating to divergence in general. So just to recap from the previous video, I remember mentioning that the following. So number one, divergence is not a signal that the market would be reversing right now. So as I mentioned in the previous video, divergence really isn't an element that essentially implies that the market would reverse right now. Rather, it's just an indicator, or rather, it's a signal that the underlying dynamics of the price do not match what the price is currently doing. A simple example of this would be the price would be making a higher high, but then an indicator such as the RSI would make a lower high. I didn't match this up, but I think you get the point. The RSI, which essentially measures the strength of the market, or rather the dominance between the bulls and the bears in the market, would essentially dictate or indicate that while the buyers were able to push the market higher, that move did not carry as much dominance compared to the previous initial moves. So that is essentially divergence. The next element that I indicated, or rather discussed or highlighted on in the previous video, was some of the aspects that tend to result in divergence occurring. These aspects include liquidity, changing participation within the market, volatility, imbalances, and essentially shifting positioning between buyers and sellers within the market. Of course, some of these factors might occur altogether within a specific level, but then in some cases it may just be one or neither of any of the factors that I've mentioned. Regardless of the reason why it is happening, it is up to us as traders to recognize that it has happened and therefore determine how we are going to be reacting to these occurrences in the market. So right now, an element that we cannot argue against is the fact that divergence does occur in the market. So how do we take advantage of this situation? Of course, we need a specific indicator, or rather tool, that measures the underlying dynamics of the market, which would essentially allow us to visualize the divergences and detect them once they happen. And then the next step would be to take advantage of them. In this case, there are multiple or various indicators that can be used to detect divergences. One of the most popular is the RSI, which is essentially a momentum indicator. Conceptually, the RSI measures, or rather compares, the bullish momentum strength versus the bearish momentum strength. It compares the average strength of recent upward closes against the recent downward closes. Technically, this implies that it attempts to represent the directional momentum balance. If I may explain this in a different way, we could say that in a predominantly bullish move, RSI rises, and in a predominantly bearish move, the RSI would drop, because it essentially indicates that in that specific move, the buyers or the sellers were dominant. So that's the RSI, and it tends to adapt pretty well, mostly in trends, but it also works pretty nicely in ranges. This is not the same as, or rather, this is actually fairly different from the stochastic, since it is how the stochastic works. it tends to measure where the price closes relative to a recent range. So whenever you are in a range, it would compare the closing price for a specific candle to the predominant range within the specified period of time. So essentially the stochastic would compare the current close against the recent high or low of a specific range. So if the price closes near a range high, the stochastic would rise, and if the price closes near a range low, the stochastic would fall. This essentially implies that the stochastic is highly sensitive to short-term range positioning as opposed to trending markets. So you'd find that whenever the market is trending strongly, it would perform very poorly, and it would essentially stay at the overbought and oversold levels depending on the trend that you're looking at. The same would apply to the MACD indicator, but it would be different to some extent, since it essentially, the MACD itself, or rather the MACD line measures the relationship between the fast and slow moving averages. This essentially implies that the MACD is heavily focused on the trend acceleration and trend deceleration and momentum speed. It measures the three things. So whenever you're trying to use the MACD in divergences, whatever it's trying to detect, it's essentially detecting the trend slowing down. So for instance, if the price makes a higher high, the MACD would likely make the higher high. But then, in certain situations, the moving averages involved in the MACD calculations would be slightly slower, essentially depending on how fast the trend moved and how much momentum was involved in the trend, resulting in divergence. While it might also work during trends, it's fairly weak in as far as short-term precision is concerned, and it tends to be delayed due to its use of moving averages. So it's very slow to respond, and it can have very poor performance in especially choppy conditions. This essentially puts us in a condition whereby we have three indicators that tend to be used when working with divergences, but only one of them seems to be versatile enough to be used in both ranges and trends. In this case, the RSI specifically is very efficient in trends. However, once we get to ranges, if you consider the fact that you can drop down in ranges, for instance, if there is a range in the daily time frame, you drop down to the hourly. If you put this in mind, you therefore realize that in the hourly, you are likely to find a trend. So you can use the RSI across the board, regardless of the current time frame that you're using. So this is just related to indicators and indicator choice, and it kind of hints as to why I ended up choosing the RSI as opposed to the stochastic or the MACD as an indicator. Actually, if you'd like a more thorough breakdown of the indicators, why divergence itself is not a holy grail strategy, and why it doesn't work always, and the different approaches that I tend to use to improve its efficiency, you can find written outlines or written posts on my Patreon page, whereby I break down each indicator, why I don't like it, and at the end I essentially explain why I ended up choosing the RSI. But that's besides the point. Right now I just wanted to explain how I use divergence in general in my trading, and why I specifically prefer to combine it with structure, essentially taking the market structure and then adding divergence on top of it as a means to detect early signal shifts and early situations whereby the market dominance on one specific direction is shifting, so that I can get into the next trend quicker. So let me try and draw this out for you in a way that could be easy to understand. So assuming you are on the daily time frame, as we are right now, on the daily time frame, you might have a bullish trend. But then once the market has made the bullish trend, it starts reversing. So at this point, as a support and resistance trader or any other strategy that you use, all strategies actually agree on one thing, that the market would move in these regimes, a regime whereby it pushes and a regime whereby it reverses for a bit, retraces if you will, and then it would continue in the initial direction. If all strategies agree on that, of course, they might use different terminologies. They might say support and resistance, supply and demand, fair value gaps once break of structure and momentum is observed. Regardless of the strategy that you're using, we can all agree that one would be expecting the market to come back to a level that it was initially. So on the daily time frame, we have already established that we are forming higher highs and higher lows. This is a higher low, and we are just about to form another higher low. So if we can accept that, we can therefore try and detect a divergence at this specific point. That's step number one. You can try to find a divergence at this specific point. However, please note that on the daily time frame, when you're dealing with ATR values of 200 plus pips, you were essentially expecting to have at least a 200 pip stop loss. And you would also expect to have a 200 pip take profit. However, if you keep that in mind and you're trading a small account, it becomes fairly difficult to determine, to essentially take these trades, and you'd be limited even if you have 28 currency pairs to trade, or however number of currency pairs that you tend to watch. You would end up realizing that at a certain point, you cannot take other entries that are in the market. So to maximize the potential of your entries, or rather your account, you would tend to go to the lower time frames to get a tighter stop loss so that you can risk less per trade and essentially maximize your output while also minimizing your risk, since you are now not essentially putting all your eggs in one basket. For instance, in this case, euro dollar. So what I would do in my strategy, I would mark this area. So instead of trying to find a hidden bullish divergence here, I would mark the zone. And then since we are anticipating the bearish dominance to gradually fade, we move to a lower time frame. For instance, if I am using the daily here, I would move to the hourly. And remember, while the trend here could have been like this is just a rough drawing, on the hourly, we would have already formed a bearish trend at this point. The hourly would be bearish and the daily would be bullish. So my strategy essentially posits, or rather proposes, that once you get to the lower time frame, you would find a trend already. So you're no longer looking for a hidden bullish divergence. Rather, you're now looking for a regular bullish divergence at the zone, at a similar zone to where the daily zone is. So remember, you've already drawn your zones. Now you're waiting for the divergence. At this point, if we could zoom in, we would be anticipating something like this. The market would come, form a low. The market would come, let me draw that again. The market would come, form a lower low, form a lower high, and then form another lower low, and start to slightly tilt up. In this tilting point, you might see bullish engulfing candles, wicks, and such at that point. But that doesn't matter for the time being. But the thing that you should be looking out for is the market becoming less efficient, the momentum reducing, or rather, in this case, when dealing with the RSI, the bullish momentum coming into the market and the bearish momentum getting weaker. Remember, the RSI measures bullish versus bearish dominance in the market. When it is heading lower, the bears are dominant. When it is heading higher, the bulls are dominant. So if you can go back to our level, the market on the hourly time frame is bearish. It is moving and forming lower lows and lower highs. However, for the indicator, the RSI in this case, you'd find it doing something like this. Once it gets to this zone. Remember, we've zoomed in and now we are looking at it from a microscopic lens. So daily, hourly. At this point, once you notice this, you have essentially detected or gotten evidence that as the market is approaching this zone, the bears are becoming less efficient and bulls have started coming into the market. As you can see, there is divergence, but this time we're looking for regular divergence as opposed to hidden if we were just dealing with the daily time frame. The theory still stands when you're dealing with any other time frame combination. As an example, on the 4-hour time frame, the market might be heading higher. Might be heading lower. Let me use this example instead. And then it comes back to a level that it was previously. Remember, as I've covered in previous posts that are on Patreon for my blog post, I addressed why divergences don't tend to work as often, especially when you're in the middle of structure, because people are taking profit. You need to keep that in mind. Liquidity zones are shifting, dominance is shifting across the board, so you are likely to observe a lot of divergences. But if you can add divergence as an extra pinch of salt to your strategy, for instance, in this case, my strategy is mainly related to support and resistance and taking breakout trades. So in this case, if the market gets to this point on the 4-hour time frame, and we are expecting it to show some level of reaction here, and we want to reduce the amount of risk that we are risking in this case, we go to the 15-minute time frame. So while the 15-minute time frame would show a trend downwards up to here, it would start a bullish trend. Like this would appear as a bullish trend on the 15-minute. Once it gets to the same zone, if we were dealing with only the 4-hour, we'd be looking for hidden bearish divergence. However, since we're dealing with the 15-minute, we are now looking for regular bearish divergence. So at this point, we are expecting to at least observe signs or signals that the bullish momentum on the 15-minute is becoming less efficient and the bears are starting to get into the market. Of course, you can observe all this using wicks, engulfing candles, and all that. But if you add divergence to this, you have a bit more evidence. And if you had to check, you had to check 5 boxes for you to take an entry, and divergence is one of them, it essentially adds to your confidence levels in your trades. So in this case, if the market gets to this point and starts to do this, it forms a higher high, but then the RSI, which again, I will repeat, measures the dominance between the buys, the bears and the bulls, and it does this. It is showing us that bears are coming in, and this move that the buyers have just made, or the bulls have just made, is less efficient compared to the others. Based on what we can see on the RSI, we already have evidence that the market is likely to go lower. This does not mean that it will go lower. It just implies it is likely to go lower. In this case, all you need on top of this is models for entry, approaches that you use to enter the trade and take advantage of these signals. I hope you've understood the signals. If you haven't, please comment down below and I'll run another video whereby I explain all this and how it works. To give you a few examples, I'll jump to TradingView, and I think I'll show you several examples that occurred in this previous week and also this current week. Actually, today I took a trade that's related to the same, that essentially works on the same concept. So let's start on the daily. So my charts tend to be color coded, especially the boxes, these rectangles. So for the daily, I tend to use orange. So if you see orange, it's the daily. Daily is orange. Red, or rather the 4 hour is red, and then the 1 hour is blue. So if you see that, just take note and remind yourself of that. But I'll leave this here for you so that you can just see it and internalize. But in any case, as you can see, I had marked zones on the daily time frame. A lower zone that I was considering a target, and the higher zone. These zones have been around for quite some time. In any case, this is not a video on how you draw your zones. This is just how I prefer to do it. Then I go to the hourly time frame. If the markets are not really close to any of the zones, I just go to a lower time frame and find different zones. So as you can see, I mark the zones that are calling out to me and the 4 hour time zone, or rather time frame, and I just leave them be. Let me just delete that line since it's irrelevant for now. But as you can see, I have multiple 4 hour zones, and you just leave them in place. After that, as you can see, my boxes are increasing as I'm going lower. So I then go to the hourly time frame, and I'd also draw the zones that apply to the hourly time frame. Once I've done all of that, at the hourly, since I also take some trades on the hourly time frame, I would start looking for trades. So assuming we were in this week, on the 4 hourly, a zone had just been broken. This zone, it had just been broken, and as a result, we would now be waiting for a retracement. And if you can check this right now, you should be able to notice that here the market was making higher highs while the RSI was making lower highs. So this high is higher and this one is lower. This is divergence. This is just an example, of course. When we're dealing with 4 hour zones, I tend to prefer to work with the 15-minute. As you can see, the 1 hour also works, but let's go to the 15-minute and see how each of the 15-minute, how the market reacted to each of these zones. This is just as a reminder that divergence is not a holy grail strategy, and it doesn't mean that the market will reverse, but it's a good signal that the market could reverse, and it's up to you to actually get prepared, get ready to take the trade. So as you can see, red, if you can remember, was referring to a 4 hour zone, and at this point we can start looking at the market and we'd check. We have lows. The market is approaching that zone. This is the 15-minute, remember? The red is referring to the 4 hour zones, and we tend to match 4 hour to the 15-minute, or at least in as far as I trade, I tend to match them up like that. In any case, the market here formed a low and then a lower low. But if you compare the RSI, we have a low and a higher low. There was divergence in this case. Would you have taken this trade? Depends on how you execute. So there are two ways that I tend to use. Sorry, I just cleared the box map. There are two ways that I tend to execute trades in as far as divergences are concerned. So whenever I find, as you can see, I mostly trade regular divergences. So once there's a divergence here, in this case, the divergence for this one would look like this. I would either take as an early entry the initial trade here, which would be either if I get a doji candle, a hammer, or an engulfing candle in the direction that I want. If I get it down here along with the divergence, I would take the trade. But in most cases, I would only risk half, 0.5 rather, half of what I was expected to risk on this specific trade. That is trade number 1. So I would first take that trade on that candle showing me the signal, and then if the market breaks this level, the level that's giving us this next leg, if it goes and breaks it at the candle that closes here, I would add the rest of the other half, and I would keep adding as long as the market is breaking these levels. Of course, you might argue that my final trade, if I keep doing that, the final trade that I add at this point would likely be in a loss, but it wouldn't really matter to me as long as I've made money along this way. So you can just take that loss or handle it using hedging, the way I do it at times. But that's essentially discussion for another day. I hope you've understood the two different ways that I use to essentially execute these trades. So let's go down here so that I can show you what I mean. So as you can see here, we got a huge candle pushing lower. Remember, we have a divergence here. Huge candle pushing. If you would consider this one as a signal, this is just an example, you would place your entry there. In my case, I tend to prefer placing my entry a few pips above that candle, and this would be with half the risk, and I would wait. So if, as you can see, this is the next leg, this one, the next leg, at this point, if the market closes well above this zone, I would add the other half. However, as you can see, the market did not. So I would just close this trade at a small profit. It would be a scalp-like trade. Another divergence formed here. We have a low. The market was still heading lower, but if you check this trajectory, the market kept forming multiple divergences. So have that one. We have this one's like multiple divergences here, but I would consider the only divergence I would consider as valid is the one that occurs below this zone. So it would either be this one, in which case if I could have taken that trade, I would be waiting for it to get past here so that I can add my second half. My first half would be here, and if my stop loss was way below this zone, around here, I wouldn't be taken out. However, if I could have used a tighter stop loss, I would have been taken out. Alternatively, there is a hedging approach you can use along with this, which I'll be covering in another video in the future. Regardless, that's one trade. The other trade would be around here. We have a low divergence forming between these two different zones. There is divergence around this area. So I would place my initial half there. You don't have to do this initial half. You can just take the first trade once the market clears the most recent leg. So if this was the market, you would wait for it to close above this zone, essentially a change in character. The ICT traders tend to call this change in character, but it doesn't really matter how you call it. Basically, you can either take the full 100% here, 100% of the risk that you are planning to take, not 100% of your account. Let me correct you on that. So essentially 100% of the risk that you are planning to take here, or you can do 50% of the risk there and 50% of your risk here. So if you're planning to risk 1% on the trade, here you would either risk 100% only here, or you would take 0.5%, 0.5% there, and then 0.5% here, depending on your risk tolerance. Now that is the entries. As you can see, the market went back to this zone, and let's just check if there's any divergence. Here, the market was formed a high, a high, a high. However, let's compare these levels. There's divergence. So you could have either taken an entry here, depending on the candles. As you can see, I'm not really getting a signal here. This candle formed with a wick. Let me zoom in I know you guys might not be able to see well, but if you check out this candle, this one, yes, we got a signal at this point, but then the next candle that could have confirmed our entry formed a wick on the underside of the candle, implying that the sellers, if you study candlesticks anatomy, you'd notice that the sellers, the way this candle formed, it opened at this point, the high, pushed lower, and then the sellers pushed it higher, and then it closed. This push down and then higher is what formed the wick. So essentially what happened here is the buyers came in and they overpowered the sellers to some extent. The sellers still were able to make sure that the buyers could not reclaim the highs, but then we still got this. So I wouldn't have taken that, but this one is more compelling. Is there still divergence? Yes. In fact, there are two divergences at this point and at this point. You could check the numbers and confirm, but there are two divergences. We have a doji and then a fairly good candle, and if that one was not a good one, we would also have this one. So you would place your entry there. Stop loss depending on your preference here or above the zone depending on your risk tolerance. This is just a preference that you need to decide on how you want to handle that. Of course, I have my own approaches for handling it, but this video is not for that. So you would take the trade, and depending on where you'd be exiting, you'd either be looking at 1:11 or whatever it is you had risk. The other approach to tracking this trade would be to take it at this point. Why? This is the low that formed this leg. So when the market closes below that point, we already have divergence and it has already been confirmed, and this candle closes strongly, so all we need to do is to take that trade. Stop loss can go above, and then you do this. So as you can see, this is a more conservative entry approach, and yes, you do have a larger stop loss, but then it's safer. You can also take both the way I tend to do, half there, the initial half, and then the next half here. So you'd have two trades running. Your average entry would be at about this point, and that's kind of good too. So depending on your preference, that's how you would have taken those trades. When the market was getting here, this 4 hours time, this 4 hour zone would not have formed. So let's essentially check out the hourly zone that formed afterwards. From this high, and then we went there. Oh, the market came back here. As you can see, the market came here very quickly, I think maybe due to news, but then we didn't have any divergence, and in my opinion, you don't really have a signal for taking this. If you'd prefer, maybe you could have taken it when it closed above this zone, but that's a different strategy than divergence, and you don't trade that here. Next, we have the market coming back to the 4 hour. Remember, red refers to the 4 hour time, 4 hour zones. Now we have this movement. Divergence. This is the 15-minute. We're using the 4 hour zone. Forget about the blue hourly zone. We'll go down to the 5 minutes to show you how this looks like in the 5 minute. But as you can see, we have an entry potentially here, but then it will depend on your preference on whether you want to take such an entry. You don't have to. So in my case, I would have taken it here below these candles, or here when the market closed below. So either here, and I tend to require a strong close, or at this point. Let's see, at this point. So half and half. Half. And then exits, it depends on how you manage your entries and exits. So in my case, I tend to be more flexible with them since I also hedge, but I'll be covering my hedging approach later. It's not the trim the hedge approach that's on the channel at the moment. It's actually different. So as you can see, no divergence here relating to this. And actually this movement was news. I panicked a bit here. I remember when I was trading this one, I panicked a bit, but I was able to manage it after some point. At some point, since I was already in this entry and I was trying to manage this one, and then the market eventually capitulated and we were able to deal with those losses. Same case as when the market came back here, but since this is now on the hourly zone, it didn't really get into the 4-hour zone. I'll be covering that on the 5-minute. And today we had a very beautiful entry in my early morning relating to this area. So at first the market gave us divergence here, and here. The one that I saw first was this one, and then I waited since I noticed a lot of wicks. But then after this candle formed, this one, I added a very tiny trade. It was like 0.5 lots, I think. Yeah, it was a tiny trade. And then yeah, I think this is how it was positioned. I was to hedge below here. I didn't use a stop loss. The market didn't really get there, and then it gave us another entry, or rather another signal. If you check out these lows, this low is actually lower than that one. So this is essentially the exaggerated divergence that I covered in the previous video. So an exaggerated divergence where the market sticks at some point, but then if you look at the RSI, it's doing something very interesting. It's rising. The sellers are trying to push the market, but each of the successive moves is less efficient, and the buyers are just taking over. It's like the orders are getting consumed as they are being placed. They're placing a sell order and then it's getting consumed by the buyers. Consumed. So another point you could have entered would have been here. And then once the market breaks above this zone here, you could have added. So I was in that trade and I think I exited around, there was a high on the 1 hour zone. Yeah. When the market got past this point, I just decided to take my profits and yeah, exited that. Let's go to the 5-minute, and this time we'll be checking the hourly zone. I'm just giving you tons of examples of how you can use this so that hopefully it will help you. So in this case, there's a lot. So 1 hour, you pay to the 5-minute, you check the zones on the 1 hour, and then you just start seeing all these divergences. Here, as you can see, all of these are divergences. The same would apply. This one was also an hourly zone, but it's a high. So remember, this is EURUSD. You can open your charts and confirm this. So the market on the 5-minute, as you can see, had already started a mini trend to the low. And then when it got here, it gave us a divergence. You could have bought. I exited this trade here and then bought, went back into the zone, gave us another divergence, sold, and then I just waited. At this point, I exited again, but then the market started doing this. I got suspicious and then exited and just sold. Since I also trade support and resistance, and I was viewing this as a mini resistance before the market went lower. So as you can see, in my case, I just used divergence as an extra confirmation to essentially determine where we're going. That's one example. There are multiple examples here, but as you can see, the market doesn't always form divergence. That's why you need something else for you to use to be taking the trades. Divergence is thus an extra confirmation signal. So as you can see, in this case, we did get divergence there, but when it broke below and came back to the zone, we had hidden divergence, whereby this high, as you can see, is higher than this one. If you remember the previous video, hidden divergence, we are forming a lower high, but then the oscillator forms a higher high, implying that despite the internal dynamics of the move, the buyers were very strong in this move, very, very strong. But then the sellers were still able to defend the position. This essentially gives you confidence that the dynamics within the trend haven't shifted. They are still essentially in line with what you are hoping for. And in this case, I'm zooming out instead of in. Sorry. In this case, as you can see, you had a very, very beautiful entry there. And there was news. I don't know if it was news, but I remember seeing this in GBP USD. I also trade that. The market just tanked at this point. It was shocking, since you are like, you've just taken a trade and then the market is just moving in your direction. There was no news at this point and it was just tanking. Yeah. As you can see, there are a lot of examples occurring, but then remember, divergence must be taken in context. You need to consider the context of the market. The context. It must be occurring at a significant zone, because if you don't do that, you'll find divergences anywhere else. For instance, there and then here. Could you have taken this one? Yes. What would you have done? Either taken the loss or managed it. So for instance, maybe you could have started hedging at this point. You hedge the trade and then you'll manage it, or you just take the loss. In the future, I'll be releasing a video that showcases how I hedge. It's very different from the trim, the hedge approach. It's actually pretty hands-off. You just let the market come to you, if that gives you a hint. But yeah, in any case, that's essentially it. You just monitor the market and you check out for these divergences. They're pretty nice. They happen very often. And a trick I would leave you with, consider this. Would you just need to ask yourself this, would you consider a strategy where, this is just giving you a hint as to how I trade, the market heads higher, gives you a divergence here, you sell, and you hold that position until such a time that you get an opposing divergence. So you buy, you exit this trade, and then you just buy. Beautiful, right? I know this is just idealistic, but it's a beautiful approach that I've tested out, and it works pretty well, especially when you're patient, and it also works alongside hedging. It works actually very well with hedging, as long as you have a reasonable balance and you can be patient enough and not panic whenever stuff are happening. But I'll be covering that in a future video. Hit me, or essentially comment down below if this is actually something you'd like to see. But that's essentially it. So I hope you're starting to understand how divergence can be used, its efficiency, and how it might not actually be the holy grail. It works, and it works well, but not always. You also need to balance out and make sure that you're checking for divergences at significant zones. Until next time, see you in the next video. I'll be covering more of this. Most of my videos will be taking this format, and if you have any recommendations, questions, and all that, comment them down below and hit me up so that we can explore this. Otherwise, cheers. Thank you so much for joining me in this video.